Two university friends graduate on the same day, both land jobs paying exactly the same salary. 20 years later, one owns multiple investments, has financial freedom, and can retire whenever they choose. The other is living paycheck to paycheck, carrying debt, and wondering where all their money went. Same education, same salary, same economy. So what changed? The answer isn't luck, it isn't intelligence, and surprisingly, it isn't income. The difference lies in few financial decisions that almost nobody talks about. Today, we'll uncover why most people never become wealthy, and more importantly, how you can avoid making the same mistakes.
When people think about becoming rich, they usually focus on earning more money, a better job, a promotion, a higher salary, or maybe starting a business. While increasing your income certainly helps, history has shown that earning more doesn't automatically make you wealthy. Professional athletes have earned millions and still gone bankrupt. Lottery winners have lost fortunes within a few years. On the other hand, many ordinary people retire as millionaires despite never earning extraordinary incomes. So clearly, wealth isn't determined only by how much you make, it's determined by what you do after you earn it. Let's start with the biggest misconception.
Society teaches us a very simple equation. Higher salary equals greater wealth. It sounds logical, but reality tells a different story. Imagine receiving a 30% salary increase. What happens next? Many people upgrade their lifestyle almost immediately. A newer phone, a nicer apartment, a better car, more restaurant meals, premium subscriptions, weekend trips. Before long, every extra dollar disappears. This is called lifestyle inflation. The more you earn, the more you spend.
When people think about becoming
freedom,
rich,
your higher salary buys bigger monthly expenses. That's why some people earning six figures still struggle financially. Their income increased, but so did their obligations. Their lifestyle expanded faster than their wealth. And that's where many financial journeys quietly begin to fail.
Here's something interesting. We often judge wealth by appearances. Luxury cars, designer clothing, expensive watches, large houses, but true wealth usually isn't visible. A millionaire who quietly owns index funds, rental properties, and businesses might drive a modest car. Meanwhile, someone driving a luxury SUV might actually owe the bank more money than they own. As investor Morgan Housel writes in The Psychology of Money, wealth is what you don't see. Wealth isn't spending, it's ownership. Every dollar you spend today is a dollar that can no longer grow for your future. Rich people understand this difference. Instead of asking, what can I buy? They ask, what can I own?
Let's simplify one of the most important financial concepts. An asset puts money into your pocket. A liability takes money out. Assets include things like stocks, index funds, rental property, businesses, dividend investments. Liabilities include car loans, credit card debt, luxury items purchased with borrowed money, things that lose value while still costing money every month. Now, this doesn't mean cars or houses are bad. The problem begins when people buy liabilities before building assets. Imagine two people receive a $10,000 bonus. Person A buys a luxury vacation. Person B invests the money. 20 years later, that investment may have doubled, tripled, or even grown several times over, depending on returns. The vacation created memories. The investment created options. That's the difference.
Albert Einstein is often credited with calling compound interest the eighth wonder of the world, although historians debate whether he actually said it. Regardless of who said it, the principle remains extraordinary. Imagine investing $300 every month. Nothing exciting. No day trading, no crypto speculation, just steady investing. During the first few years, growth feels slow, almost boring. Many people quit during this phase because they don't see dramatic results. But then something remarkable happens. Your investments begin earning returns. Those returns start generating their own returns. Over time, growth accelerates. The longer you stay invested, the less your wealth depends on your monthly contributions. Instead, your money begins working harder than you do. Compounding rewards patience more than brilliance.
Here's an uncomfortable truth. The stock market doesn't usually defeat investors. Their emotions do. When markets are rising, everyone suddenly feels confident. People buy because they fear missing out. When markets crash, fear takes over. People panic. They sell. Ironically, they often sell at the worst possible moment. Then prices recover, and they buy back later at higher prices. Buying high, selling low. It's the exact opposite of successful investing. The greatest investors aren't necessarily the smartest. They're often the most disciplined. They understand that temporary declines are part of investing, not evidence that investing has failed.
If building wealth isn't about chasing quick money, then what actually works? Fortunately, the formula is surprisingly simple. Increase your income whenever possible. Spend less than you earn. Avoid unnecessary debt. Invest consistently. Own productive assets. Stay invested for decades. That's it. Notice what's missing. There's no secret stock, no magic indicator, no guaranteed cryptocurrency, no overnight success. The world's greatest fortunes were built over years, often decades, not weeks. Patience is one of the rarest financial advantages because so few people are willing to wait.
If you're watching this in your 20s, time is your biggest asset. If you're in your 30s or 40s, the next best time to begin is today. Building wealth isn't about perfection. You'll make mistakes. Markets will fall. Unexpected expenses will happen. What matters is staying consistent, because every investment, every dollar saved, every unnecessary purchase avoided is another small step toward financial independence. The difference between those two university friends wasn't talent, it wasn't luck, it was the decisions they repeated over and over again. And the same opportunity exists for every one of us. If you enjoyed this video and want more evidence-based videos on investing, economics, wealth building, and financial psychology, consider subscribing. This channel is dedicated to explaining money clearly without hype, get-rich-quick schemes, or misleading promises. If this video gave you a new perspective, share it with someone who thinks earning more money is the only path to becoming wealthy. And let me know in the comments, what financial lesson changed the way you think about money? See you in the next video.